Welcome to the Explainer. Today, we're zooming way past those complex charts and flashing stock tickers you're so used to seeing. Instead, we're going to uncover a massive, highly sophisticated, and honestly, completely invisible digital universe. We're talking about the hyper-fast engine operating behind literally every single financial trade made on the planet.
Think about your own experience for a second. You pull up a smartphone app, swipe to buy a stock, and boom, a second later, it's yours. Feels pretty simple, right? Well, behind that effortless little swipe is a multi-billion-dollar institutional arms race. Seriously, in an era dominated by high-frequency trading and crazy complex algorithmic models, what you're trading almost matters less than the tech you're using to actually execute it. This tech isn't just a handy tool. It's the definitive line between raking in multi-million-dollar profits and suffering devastating slippage.
Okay, let's dive into this. Here's our roadmap for today. 1. The financial highway. 2. The trading stack. 3. The need for speed. 4. Private versus public cloud. And finally, 5. The liquid-cooled AI future. Let's get to it. Section 1. The financial highway. Let's start by actually defining what we mean by trading infrastructure. So, at its core, trading infrastructure is the whole shebang, the comprehensive network of hardware, software, telecommunications, data frameworks, and protocols that actually allow trades to be initiated, verified, routed, executed, and settled. Now, it's absolutely crucial to remember that this infrastructure, it doesn't make investment decisions. It doesn't magically predict stock trends for anyone. Instead, think of it as the ultimate financial highway system. It's the completely neutral ground, the roads, the traffic lights, the toll booths, that lets the global economy's lifeblood of liquidity just flow without any roadblocks. Let's move to Section 2 and see how this builds out. Anatomy of a trading stack. We're zooming right into the physical layer. All right, we got to start with how data physically travels. Now, we all know light is ridiculously fast, right? But get this. Did you know that standard glass fiber optic cables actually slow light down by roughly 33% compared to a vacuum? Yeah, it's mind-boggling, but in the world of high-frequency trading, a 33% speed reduction, that's considered devastatingly slow, like entirely unacceptable. Now, what's really interesting about this is the extreme lengths these firms will go to just to bypass that 33% lag. To get around it, top-tier firms are relying on hollow core fiber, or HCF cables. These literally pass light through tiny air pockets to achieve near-vacuum speeds. And they combine this with terrestrial microwave towers that shoot signals in perfectly straight lines, literally slicing right over mountains and plains between major hubs like Chicago and New York. All of this intense physical engineering exists for one reason: to shave off fractions of a millisecond. But, physical distance always equals a time delay. And this brings us to a huge concept: colocation. Firms pay an absolute premium for real estate just to house their servers inside the exact same data centers that hold the exchange's matching engines. And here's a pretty wild insider secret about how this works in reality. To maintain strict fairness, clearing regulators make sure that every single participant's server rack uses exactly identical lengths of yellow fiber cable. I'm serious, they measure it down to the nanosecond. That way, no single server rack gets an unfair physical advantage just because it happens to sit a few inches closer to the main engine. So once the data physically arrives, traditional operating systems and CPUs introduce these unpredictable processing delays. It's a massive headache, known in the industry as jitter. To avoid this jitter, modern infrastructure literally circumvents the software entirely. They use custom microchips, known as ASICs and FPGAs. These chips receive the incoming market data packets and instantly route the orders directly on the silicon hardware itself, in mere nanoseconds. This completely bypasses the clunky, time-consuming software operating system and that pesky CPU jitter. Now, of course, sometimes heavy algorithmic processing does still require software. But when it does, engineers absolutely refuse to use common languages like Java or Python. Instead, they go for low-level languages like C++ or Rust. Why? Well, these languages give engineers super precise control over memory management. It completely avoids those random garbage collection pauses you get in other languages, pauses that could, no joke, stall a trading system right in the middle of a massive transaction. Moving on to Section 3, why this speed matters. Let's look at the high-stakes reality. So you might be wondering, why do institutional players spend billions of dollars every single year on custom silicon chips and hollow core fiber optics? Like, what are the real financial risks at play here? Well, the foundational reason is eliminating price slippage. Slippage is basically when an order executes at a different price than what was quoted.
In a super volatile market, a delay of just 5 milliseconds can cause a stock price to tick upward, costing a fund thousands and thousands of dollars on a single block order. But it's not just about slippage, it's also about managing toxic data bursts. See, markets don't flow smoothly. They erupt in these explosive, unpredictable waves, especially during black swan events. A robust infrastructure has the bandwidth to process millions of messages a second without just completely crashing. And beyond all that, there's the absolutely crucial need for stability and compliance. Under strict frameworks like Europe's Digital Operational Resilience Act, or DORA, systems have to run automated pre-trade risk checks instantly, specifically to block erratic algorithms before they trigger a massive flash crash.
This brings us to Section 4, Private Servers versus Public Cloud. Where exactly does all this hardware live?
Despite the massive boom we constantly hear about with public cloud platforms taking over the world, the reality here is starkly different. And this brilliantly illustrates it. According to market research from Coalition Greenwich, a majority of financial firms, 53% actually, strictly maintain private on-premise infrastructure for their front office operations. Let's look at the specific trade-offs straight from the source, just to understand why top-tier firms currently demand a hybrid architecture. Private on-premise or colocation setups handle the live order execution and the high-frequency trading. The massive advantage here is predictable nanosecond latency and having full physical control. But the obvious trade-off is exponentially higher capital expenditure. It costs a fortune. On the flip side, public cloud ecosystems are used to handle post-trade settlement and backtesting. They give you limitless storage and super rapid scalability, but they suffer from unpredictable network hops and microsecond delays. The cloud simply cannot yet match the hyper-deterministic speed you need to fight for order fills. And that is exactly why the hybrid model remains the absolute gold standard right now.
All right, final stretch. Section 5, the liquid-cooled AI future, the next evolution. As unbelievably fast as this infrastructure is today, it's mutating rapidly right now. We are seeing an explosive integration of generative AI and machine learning directly into trade execution. But here's the catch. Traditional servers are totally ill-equipped to handle the massive mathematical computations required for this. Live AI models are constantly evaluating market sentiment and digesting huge order books simultaneously. Because of this immense strain, data centers are completely reinventing themselves. They're shifting to specialized AI clusters packed with massive GPUs. And these run so insanely hot that they require complex liquid cooling setups and ultra-fast optical switches just to operate without completely melting down.
So, the crucial point is really tying it back to that contrast we started with. For the average retail investor tapping on a smartphone app, this totally invisible infrastructure just ensures your order is filled safely in the blink of an eye. But for the global institution operating behind the scenes, it is a relentless, absolutely ruthless, nanosecond by nanosecond arms race.
As our source material so perfectly concludes, having the second fastest infrastructure is just an expensive way to lose. In this environment, second place yields absolutely nothing. It is this quiet, intense convergence of quantum physics, software engineering, and global economics where only the absolute fastest survive.
Which leaves us with this final thought to ponder. As markets grow increasingly automated, relying on hollowed-out fiber optic cables and liquid-cooled AI chips, who really controls the speed of money? Thank you so much for joining me for this explainer. And hey, keep questioning the systems running invisibly all around us.